What industries, and of course, obviously I'm thinking about the gold miners we wrote about here, and obviously I'm thinking about commodities, these industries are at a point in the capital cycle where you think they are worth buying?
Right, so that would put me on the spot rather more, wouldn't it, than giving you tips as to which
As to what
stocks
to
have
do 10 years ago.
done well over the last
Put you on
day.
the spot a lot more, but
okay,
you've written
now
it down in real words,
okay,
so
I
you
have
can
written,
see it on video.
I have written for you a piece that is bullish on gold miners. And the argument there is this, namely, the gold price, if you remember, went up from around, what do we say, $252?
Around where we first suggested MoneyWeek readers buy.
And hit a peak of what?
1,800 and something, can't remember.
So it had gone up tremendously since 99. The gold mining stocks went on a decent. The gold mining stocks were always described, and they still are described, quite wrongly, as an option on the gold price. Like, if you want gold and you want a supercharged investment in gold, then you want to buy gold stocks, and that is just a guaranteed way of losing money. The gold. Well, you know that, yeah. And any of you who own gold stocks over the last 15 years will know that too. So the question is, why did the gold price is still up? Was it roughly 3 to 4 times, let's say, from its trough? I mean, the trough was it was really around 300 that it was trading, and it's now what, 1050 or thereabouts. So it's up around three times from the trough. But the gold miners have gone nowhere, and recently they have lost a great deal of money, and they've underperformed the S&P 500 over the last 5 years, even though the gold price is still more than doubled. So the question is, why did this happen? And the answer is quite straightforward, is that the gold miners, the guys running the companies, blew the money. And what they did is as the gold price went up, they invested more and more and more. And they embarked on some phenomenally bad, loss-making capital expenditures, of which Barrick Gold, the world's largest miner, blew, I'm saying around $5 billion on some South American mining venture up in the Andes on the Argentine-Chilean border. And they blew $5 billion without extracting, as far as I know, a single ounce of gold. And they have now closed down the operation and written it off.
On the basis that the cost of production would be too high at the current gold price, or at any gold price?
Well, they were just, they were running into any number of different, operational problems. But the point of this is that, and it's not so dissimilar from the housing or .com or whatever. You have either a rising price of something you sell, or even a future demand drives capital investment. And capital investment tends to be overdone and is, as we know, cash flow negative. It costs money in plain simple terms, and then if it's done with sort of your too ebullient spirits, it leads to a misallocation of capital. And the gold miners have done that in spades. They really are the worst capital allocators out there.
I thought you said they weren't uniquely awful.
They're not. Well, I was understating things.
Okay, they're uniquely awful.
They are uniquely awful. I'll tell you why, and you know this as well as I do. Is that if you look at the long-term historic return of gold miners relative to the rest of the market, they're around 2 percentage points annually worse than the rest of the market. Now that has to be telling you something.
Uniquely awful.
They are uniquely awful because they've got, as we were saying earlier, too many spivs and crooks running them. But this is not a problem of spivs and crooks. This is a problem of incompetence, of stupid, incompetent people who get sucked up in the gold mining, gold bull market and throw a lot of money away. So my argument is this, that the best thing that ever happened to an investor in gold mining stocks has been the collapse of the gold bubble from 1800 back, by 40% or so. And the reason, this very simple intuition, is that if the miners could not make money when the gold price was going up, well, they bloody well ought to be able to make money when the gold price is going down. And the reason they'll make money when the gold price is going down is because they will put a cap on their future expenditure.
And they will shut down unprofitable mines.
They'll shut down unprofitable mines. And actually, I'll tell you, so one of the companies I cited in my piece is a company called Newcrest, which is an Australian miner with operations in Indonesia. And what's interesting about this company is that it's now being run from someone brought in to run it, who's outside the gold industry. He doesn't really care about how many ounces of gold they extract, and he's setting the new metrics that are being set are cash flow generations, return on invested capital, and so on.
This is new.
This is new. These are businesses being run like businesses rather than being run to pull some yellow stuff out of the ground for its own purpose.
Yeah.
And I think that, and I'll tell you, this is another interesting thing about gold, is that although one can say that the amount of gold, and you know this, the amount of gold mined really doesn't make any difference, because it's 2%, the amount mined in any year is 2% of the above ground stock. Yeah. Having said that, that there will be no new gold supply on the market over the next 5 to 10 years. It's pretty clear that I told you when we talked about earlier about we don't know what the demand for gold will be. It might be high or low, but we do know there will be no supply. You could argue that the supply doesn't really make that much difference, but in the long run it probably does make some difference, and there's going to be no new supply. Now, I think this is where gold differs from, well, in particular, basic materials mining, such as iron ore mining, because in that instance, there has been a huge surge of investment, and that investment will carry on coming forward, and they will. And it so happens that the new iron ore mines have a cheaper costs of extraction than the old ones, so there's no incentive
to shut those
to
down.
shut those down.
Yeah.
So we have a sort of combination of new capacity coming on stream, and that being low cost. So that will be there, and we don't know whether demand is going to be high or low. As a China bear, a so-called panda. You and I, we're called pandas now.
I didn't know that.
The pandas,
China's pandas.
Pandas,
okay.
like you and I, will actually think demand will be fairly weak. But if we put the capital cycle hat on, we'll just say is that there has been a lot of massive new supply, and that supply will continue for a while to come. So everything else being equal, and you can come back and we'll see in a few years' time whether this is right or wrong. I'm going to say that the gold miners, even run by blithering idiots, have at this moment a better prospect than the conventional miners which by and large are run by much more professional people.
All right, so we're going to buy gold miners. We're not quite going to buy the other miners yet. Oh, the big miners. We're probably not going to buy oil yet. Oh, look, doubtful.
I mean, oil is, to tell you the truth, I haven't quite done enough work on oil.
Oh, take a guess.
No, I mean, so the bull, you like a bull story.
Yeah.
So the bull story is and it's a capital cycle story, is there has been a a surge of investment in energy. Yeah, we all know that. A lot of it didn't come to anything. Like, the big oil majors spent a lot of time drilling holes in deep water in the Arctic or this weather, and they hardly managed to despite all this expenditure, hardly managed to replenish their reserves, let alone build up any new reserves. However, in the States, where money was dirt cheap and someone had discovered fracking, of getting oil from through the fracking process, there was a huge investment in fracking, in, if you will, sort of wildcat rigs across states, and that has expanded supply, as far as I understand, by 2 or 3 million barrels of oil a day. Now, again, from the capital cycle perspective, those frackers are toast, and they're going out of business now.
Are they? Even though their cost of production is getting lower and lower?
Well, you have to get sort of Jim Chanos in. He was presenting on this subject the other day in the presentation I went, and the argument there is that a lot of this new supply in the States is only profitable at $60 to $70 a barrel, and the analysts have sort of $80 in their models, and so they're sort of pricing it off a much higher oil price. So let's assume that in the first instance the price of oil stays about roughly where it is, and these wildcat frackers who've increased supply disappear over the next 2 or 3 years. And let's also assume, this is not quite certain, that those oil wells that they've uncovered was just a short increase, as a temporary increase in supply. I mean, some people compare, I don't know nothing about the oil industry, but I like the idea that you compare an oil well to a can of Coke that has been shaken up, and you open the lid, and it gushes out. Now, what I understand is that the frackers, that it gushes out just much faster than a conventional well, and it could be, and no one's 100% certain about it, so they could have much shorter lives.
Well, I understood that there were these vast fields that would last for many, 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 many years, and also, more importantly, that they can be turned on and off really quickly. So there's sort of swing producers that will hold the price of oil at sort of $50, $60 indefinitely. I guess that's the bear case.
I mean, but Merryn, that may be the bear case, but you have to bear in mind that that's the sort of bear case that's sort of put out after the oil price has
already
fallen 50%. I mean, when it was up, I mean, Goldman's, for instance, now is saying oil price at $50.
We all remember their $150 call, don't we?
$300.
Was it $300?
Well, you have to go back to, I think, 2008. They were calling 300. Now, the point of this, as you know, is that as Jim Grant says, markets make opinions, not the other way around. So a low oil price will engender thoughts that there'll be a huge amount of supply at the margin. Some intelligent people believe that may not be the case. In which case, if you take out the frackers, you could take out a couple of million barrels of supply, and you might find that the supply conditions for the oil industry, forget about demand, could rectify much more quickly than, say, for iron ore and conventional mining. So if we're going to put a category, do you want a category of bets? We're going to start from a capital cycle perspective and say the gold miners look ripe about now, regardless of what happens to the gold price. But as I say, the lower the better, because it gets rid of the marginal producers. The energy guys are worth keeping an eye on, and do you want to? Someone gave me quite a nice idea. If you want an idea.
Oh, absolutely. We always want ideas.
Yeah.
Particularly when they're second hand.
Where's one going to get an idea from if it's not so? So one of my former colleagues, I was talking to him about the subject, and it's his thesis that the that the fracking supply could come off fairly rapidly. And I asked him, so what was he interested in? He's not interested in the big energy, the big oil, because, well, they've had a pretty wretched time over recently, and they're having trouble, just as I say, replenishing their reserves. However, if you want to be politically incorrect,
Always.
Canadian tar sands businesses have apparently, and you can check up on this, they've apparently they have invested a lot in their startup investment, but their marginal cost of production is lower than the frackers. So it's conceivable that if you wanted to leverage play on a long supply of oil, in other words, a stream of oil coming out for the next 30 years or so, that you should look towards the tar sands business. Now, the environmentalists will not be pleased if you buy these stocks.
No.
However, I'm told, so for instance, one called Canadian Natural Resources, apparently a good stock run by good company run by.
Wouldn't this also maybe then be a wonderful time to buy Russian oil companies? They're they're double cheap. Is that too much for you? That's just too much.
I own some. I mean, I look. The test of another test of a good, of whether you made a good investment is you buy an investment and see it halve in price, and do you want to own more or do you have second thoughts? The point is, if you own something in Russia and it halves in price, it is technically cheaper, but then you realise it is a country run by a very unpleasant man who not only is prepared to invade his neighbours, but has absolutely no concern whatsoever for the interests of domestic, let alone foreign investors. I mean, foreign investors on Putin's list of priorities is extremely low. And if you don't know that, then you can read that book, rather good book by that fellow Bill Broder. I think it's called Red Alert.
Yes.
Came out earlier this year. And explaining what happens if you invest in Russia. So the trouble with Russia is, yes, stuff is cheap, and particularly the Gazproms of this world, the Gazproms of this world, but their cash flows are diverted by Putin to his cronies and perform national service. So, and I mean, it may be that they're so cheap you can't
That
lose
doesn't
money.
matter.
But it is no. I mean, look, this year, the Russian stock market is one of the best performing.
Exactly. This is my point. Depends how much you care about this stuff. If we're being politically incorrect.
Well, no, I don't. I
this
don't
is.
care. I think my own preference is to separate one's sort of social concerns from one's investment. Because I mean, if it's legal, I think you should, in the investment world, do it, really, so to speak. And if it if it shouldn't be legal, I think someone should frame a law against it. I think that's quite right. Now, I mean, with Russia, I suppose my feeling about this is not just with Russia, but really with a lot of the emerging markets, because there is no, if you want to call it, corporate governance, and because there's no rule of law. I mean, what is your claim on property? So you can get, I think Russia is really a sort of binary proposition. You're either going to make money,
or you're not going to
or
have
you're
any
not.
left at all.
So my own
Okay.
view is just not is, and I did it myself, but I didn't double down. Is have some small exposure because it's very cheap, but don't but be prepared to lose it all.
Yeah, no, we have that as well. Some small exposure to Russia. Anyway, I think we better leave it there. So thank you very much. So now we know, buy gold, buy politically correct oil. Don't
Incorrect oil.
Well, it's both. It's politically correct because it's in Canada, and politically incorrect because it's tar sands,
Yeah,
right?
actually, yeah.
It's both. Maybe that evens out. So buy neutrally correct oil and neutrally politically correct oil.
Okay.
Either way, gold
and
miners.
buy Capital Returns, my
Oh, and buy Capital Returns, the book, because that's going to be a fabulous investment. Should be in everybody's Christmas stocking, right?
I wouldn't put it in a Christmas stocking personally, but you could buy it for the reading in the new year.
Perfect. Thank you.
Thanks, Merryn.
I'm anticipating that there's going to be a run on cash, that people are going to want real cash. And by real cash, I mean dollars.
You mean actual notes?
Pieces of paper.
Actual notes.
Pieces of paper, because the whole economy works on credit. In a